Good afternoon and welcome to the AFENTRA PLC trading update. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just simply type in your questions and press send. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Paul McDade. Good afternoon to you, sir.
Thank you and welcome everyone. Thank you for taking the time to join us for today's update following a recent trading statement. Today, what we want to do is focus on a number of areas. It's actually just about 5 years since we started AFENTRA back in February 2021. And I think what we'll be able to demonstrate today is the extensive portfolio that we've built within Angola. If you look at the recent update on reserves and resources, we now have approximately 120 million barrels of 2C and 2P reserves and resources. And at current production rates, that equates to reserve and resource life of about 50 years. A clear indication that we're at a point where production is about to grow and grow significantly. Also, over the recent period, we've continued to deliver strong production and strong revenue, and that has continued to support significant investment in our core assets offshore that Ian will talk about. But it's also continued to support the broader growth of the company, and as I say, building out that newer portfolio. As we look ahead into 26 and beyond, for the next 5 years, what I think Ian will demonstrate is the very significant production growth we have ahead of us. And we have some near-term activities later in 26 that will start that material increase in production. We anticipate that we can up to triple production as we head towards 2030. Obviously, funding that investment is a priority, and managing our balance sheet appropriately will continue to be a priority. And as you've seen historically with AFENTRA, we've taken a prudent approach to our balance sheet. We have very low debt at the moment, and we're currently looking, Anastasia will talk to that, at how do we restructure the balance sheet in preparation for this next period of growth. So with that, I'll hand over to Anastasia to run you through some of the financial figures and financial background for the period.
Thank you, Paul, and good afternoon, everyone. As Paul mentioned in his opening remarks, 2025 has been another year of consistent delivery and very disciplined execution. Production has been in line with our expectations, with cash generation reflective of the softer oil price environment of 2025. Total debt has been reduced with the principal repayments made during the course of 2025. In fact, since we took over the assets and funded our acquisitions, we have already repaid 40% of our initial borrowings. Our capital allocation was disciplined and primarily focused on the ongoing revamping and integrity campaign, as well as preparation for the drilling and workover campaign in 2026 that Ian will talk about later on. As a partnership and with a soft commodity prices outlook in the first half of 2026, our preference is to commence activities later in the year. However, these campaigns are advancing and we're getting closer to the technical readiness. We have additionally progressed our portfolio with the completion of the operated Block 324 license, which provides an additional exciting growth potential for AFENTRA. With the addition of these operated positions, the team is keen to progress on the basis of our deep operating experience to support the next phase. We also anticipate completion of CON4 and ETO transactions in the very near future. It is important we get both the pace of investment and the timing right in this volatile commodity price period, and as such, we remain flexible in our approach. We're positioning the company for meaningful production and cash flow growth with a clear opportunity ahead. Execution will be measured and cautious, focused on getting the timing and the financing structure right. Moving on to the following slide, we'll talk about the cash reconciliation for the period. Again, for those familiar with our presentations, you would remember similar slides in the past. The asset cash generation here, again, you would recall that we always show it on an asset basis after all OPEX, all fiscus, including all taxes, but also equally as importantly, we show it on the basis of all material capex outlays in 2025. So it's a net figure. In the first 2 years since the completion of the acquisitions, high oil prices have helped to build a very material cash balance that we benefited from during the course of 2025. That allowed us to satisfy the increased capital commitments, fully fund corporate requirements, and to also to pay down the debt. We continue to carry very light debt levels relative to many of our peers. We're in an investment phase at the moment. Cash burn is linked to asset build-out and growth preparation will continue. The focus is on calibrating deployment while maintaining balance sheet discipline. The next slide shows our plans for the crude oil sales and our hedging position for the year. Our projection for 2026 is an estimated crude sales of 2.3 million barrels. This is based on production levels similar to those of 2025 and does not include any additional production from the drilling and heavy workover projects. The very material uplift relative to 2025, when we monetized 1.6 million barrels, is due to the timing of offtakes that resulted in a stock of 363,000 barrels shifted from 2025 into 2026. In fact, we already monetized that stock as we sold 517,000 barrels at an average price of 65.38, and that took place in January. We target an additional 3 to 4 liftings this year at around 400,000 to 500,000 barrels per offtake, with the next offtake anticipated in April, followed by a July cargo. In the later part of 2025, we made a decision not to hedge Q1 2026 offtake. However, we stayed opportunistic, and with the recent uptick in oil prices, we have hedged fully the ballast of first half of the year, and we added a layer of hedges to provide a level of certainty for the second half of the year. We generally would prefer to maintain a high level of hedging and will continue to stay dynamic and opportunistic while maintaining balance sheet discipline. Slide 7 touches on our debt profile and working capital facility. For those who were with us in the previous presentations, you would remember that we have initially secured financing with Trafigura and Mauritius Commercial Bank in the second quarter of 2022, when we completed our acquisitions of assets from Songol, Azule, and INEC. Both facilities have been secured at competitive market rates and worked well for us so far. As we enter a period of material growth, we continue to maintain optionality with regards to these facilities, which are both flexible and can be repaid or refinanced at the time of our choosing. As we look at the growth potential ahead, we recognize that the balance sheet will need to evolve. We're actively reviewing both facilities with the objective to reshape the debt profile to fit our ongoing funding needs, coupled with refinancing into a larger RBL or a term loan facility when warranted to support our growth ambitions. We're actively assessing options and will move in a measured and prudent way given the current oil price environment and funding requirements. Slide 8, very quick recap. The ATU transaction we signed in June 2025. That is a strategically compelling acquisition which progresses well through the approval process. Timing of approval remains procedural rather than conditional in nature. The effective date for this transaction is end of December 2023, and it's subject to customary completion adjustments. It has been taking a little bit longer for us to complete this acquisition. However, the pattern is not too dissimilar to all prior deals, and we anticipate the completion to occur in the near future. Finally, slide on the capital allocation framework, page 9. Where do we see the priorities from a fiscal and shareholder value creation in returns perspective? Our core objective is in maintaining balance sheet growth, flexibility, and also we aim to deliver shareholder value. Our priority number 1 is the ongoing reinvestment into our existing assets to drive future growth. We built a strong foundation for infrastructure investment through the period, and now we're moving into drilling and workovers to grow production and reserves. Balance sheet strength is critical. We made substantial progress on the investments so far. We will accelerate activity in a measured way, supported by the right financing structure and market conditions. With regards to the inorganic growth, we continue to screen and evaluate new opportunities in Angola and also elsewhere in West Africa, focused on value creation and disciplined execution. We're not pursuing deals for the sake of deal announcements. Any deal that will progress to announcement needs to be justified from a shareholder value creation perspective. Finally, when it comes to the shareholder returns, our current priority is reinvesting in accretive growth while preserving the flexibility to return capital to shareholders at the appropriate time. And with that, I'll hand it over to Ian.
Thank you, Anastasia. So we'll build on the financial framework. I'll walk through the operational side of the business. We're now moving into the next phase of the business, focused on executing the growth opportunities in front of us and accelerating value delivery. Offshore, we believe the portfolio we hold today has the capacity to more than triple production over time. And on the right, there's a slide that we released a couple of weeks ago. And I'm going to walk you through the specific projects that drive some of that ramp up in today's presentation. Onshore, it's early days, but the work is already well underway. COM15 on the right-hand slide, we've begun identifying leads, and we've just completed the regional FTG survey. So all things considered, offshore is about execution, ramping up production via infill and new developments. Onshore is about building the pipeline that underpins that future growth. So let me start with the offshore portfolio first. This is where the immediate production growth sits. And this slide really captures the scale of the opportunity. The metrics or the numbers are on the right, but we're sitting on more than 3.7 billion barrels of oil in place, plus significant gas volumes. Recovery to date has been relatively limited at the high 30%. Analogues elsewhere in Angola are in the 50s. Over the last couple of years, our focus has been invested in revamping and upgrading the infrastructure in 305. That infrastructure has huge capacity. And while doing that, we've managed to offset decline and increase production from 2023 by around 30%. And since then, we've stabilized production at the current levels. More recently, we released a contingent resource upgrade, which on 305A, the discoveries there, which was a 4-fold increase. Those discoveries are gas rich, and we have a gas management solution for 305A, which is more likely to be implemented from about 28 onwards. And those volumes come through later in the production profile. What has changed more recently in the last couple of months is Block 324. We were awarded that block late last year, and it's moved up the priority list because it offers low GOR oil, existing wells that we can re-enter, and a very cost-effective development pathway using infrastructure that already is there. So what I'm going to do is I'm going to talk today in a couple of slides about the specific growth projects that sit in front of us, infill drilling and workovers on 305, which really start to drive the production ramp up from 26 onwards. Now, before we get into the drilling and workover projects, I just want to update you on the progress we made on the revamp program and the water injection. On the top of the slide is the FSO recertification. That's now been completed, with a formal recertification expected Q1 26, and that pushes out dry docking into the 2030s. We've also been overhauling power gen, key mechanical systems, and materially improved operational resilience. At the same time, and on the bottom of the slide, you can see the progression of the water injection. Injection rates averaged around 37,000 throughout last year, but in Q4 we were at 50, and that's been continued into Q1 20 or into January 26, and the target is to move towards 100,000 barrels a day through this year. That's critical and remains a focus for us. Water injection is key to recovery. Recovery ultimately drives production and reserves growth. On the next slide, we talk a little bit about OPEX reduction, which primarily is driven by production growth. And on the right, you can see production growing from 25 to 27 to 2030, and the downward vectoring of that OPEX per barrel as the production ramps up. We've also commissioned, the partnership commission via Sonangol, an independent operational review with McKinsey. And on the left, you can see a number of those levers that they identified. That is more of a work in progress, and you'll see that more to come in the future, but particularly on logistics. Over the next couple of years, we'll be looking at how we can reduce those. The key driver really for 305 at this stage is all about production growth. If OPEX amounts stay relatively flat as you ramp up production, that OPEX per barrel goes down as shown on the right. So given we're moving into an operational phase in the second half, I'm just now going to discuss the examples that we've included in the presentation. So start off with Impala, and this is the first of our near-term production growth projects, and it's a great example of the upside that exists across this asset. There's substantial oil in place, as shown as the metrics in here, somewhere between 60 and 200 million, yet only about 12 million barrels has been produced. So that's about a 5% recovery factor if you take the 200 million barrels. Looking at the well itself, we expect it to deliver about 4,000 barrels a day. It will cost about 50 million, and we have a first oil targeted for 2026. I think the other crucial bit about Impala is that it's drilled from an existing platform. We've got 5 slots spare, and we can leverage that. In an upside case, then this development alone could add up to 50 million barrels of reserves, which is around 50% of our current 2P pace. In terms of payback, at $60 a barrel, it's under 2 years. At $70 a barrel, it's under a year. Moving on to the next project, Picasa Southwest is another compelling opportunity. It's an undrilled fault block adjacent to the main Picasa field, which, just to bring everybody's thoughts on it, has an oil in place of 1.1 billion barrels. It's had independent technical review, it's got strong structural definition, and it's on the migration route from the kitchen through to Picasa. Now, clearly there is some degree of risk on this. Impala 2 is a well in the heart of the field. Picasa Southwest is drilling in an undrilled fault block, but it is adjacent, as I said, to an existing billion barrel field on the migration route and adjacent to prolific producers. The metrics of this well, we're expecting, or we're targeting 5,000 barrels a day. It has a similar cost profile to Impala, and its first oil is targeted for Q4 26. In a success, this could deliver up to 3 additional well, and it just doesn't add one well. It potentially opens up an entirely new development area adjacent to the existing field. It could be that we actually have to deploy, or we deploy a platform on this. Again, in terms of metrics, this is payback time in under 2 years at $60 a barrel. We leverage existing infrastructure, it has low execution risk, and this one, it targets material upside. If we move on to the hydraulic workovers, this is a campaign we've been working on over the last couple of years and now moving to execution. These are low-cost, short-cycle interventions on shut-in wells. Phase 1, shown on the left-hand side of the red wells, the candidates, includes 3 workovers. We're targeting about 3,500 barrels a day of uplift in year 1, $5 to $10 million per well, with the first restarted in late 2026. The cost of development is between $3 and $6 a barrel, depending on the price of the well. What we have importantly identified is another 20 plus candidates across the fields. So it's a repeatable, scalable program, and it delivers near-term production uplift while steadily increasing recoverable reserves. Again, paybacks at $60 a barrel, we have payback under 2 years. At 70, it's well under a year. So that summarizes phase 1 of our drilling and hydraulic workover activity. I'll now move on to block 324, which is a license that we brought into the portfolio late last year. It's a step change opportunity in the near term, and it's being prioritized ahead of 305A because it's lower GOR oil, it has existing wells we can re-enter, and it sits close to the existing infrastructure, particularly in Palanca, which has spare capacity. On this block, we've got 10 discoveries. All wells were tested and flow rates were up to 6,000 barrels a day. In terms of how much is discovered, about over 190 million barrels of oil already discovered on this block, and over 400 BCF of gas in place. And that was signed at a cost of $40,000. Our initial GPQ development, Galungu Palankan at Northeast Kisama, targets around 10,000 barrels a day. And the FID is targeted for Q4 this year. It's a fast-track infrastructure-led development and a very capital-efficient growth opportunity in the portfolio. We're going to look at phase 2 on Block 324 with the other discoveries. And then some of you may notice there's yellow polygons that have now appeared on this map. These are exploration prospects that we've identified around existing fields that we'll be looking to mature in the future. So moving on to Block 305 and beyond the drilling and development of 324, we've got other opportunities in offshore. Punja, Buffalo Norte, Kakakazalua and Chefu all contain material oil volumes associated with significant gas. There's no further appraisal required. The constraint here is how do you manage the gas appropriately in order to unlock the liquids. The solution we're evaluating is tying into nearby gas infrastructure. We've talked about this previously, the ALNG import pipeline, which is at the top of the slide. And tying into there would allow us to export gas, allow the JV to export gas while monetizing the associated condensate and oil. So it's about doing the right way, reducing emissions, extending field life, and unlocking a substantial liquids opportunity that currently sits in contingent. So hopefully you can see why we're pretty excited about the offshore. As Paul mentioned, with the contingent resource upgrades with 50 years of production at current rates, we've got a large resource base and we're at production inflection point. I'll now move on to the onshore. So beyond the offshore, the Kwanza Basin represents the next layer of opportunity in our portfolio. What makes this interesting for us is it isn't just about greenfield exploration. These are areas where oil has already been found and produced and then effectively left behind. Today, we hold positions in COM 15 and 19, which are shown on the map on the right. That gives us a broad footprint across the basin. We expect COM 4 to be awarded shortly, and both these blocks, COM 4 and 15, have had oil flow to surface. So COM 4 is the real near-term opportunity. It includes previously produced fields, existing infrastructure, and a clear pathway to early redevelopment and production, and also the potential for early cash flow into the Luanda refinery. Alongside that near-term focus, COM 15 and 19 provide longer-term running room across the basin, giving us exposure to both redevelopment as well as exploration upside. And that gives us flexibility, optionality in a basin we believe has been materially underexplored. We've pre-invested in a regional FTG survey to identify sweet spots, and now that is now complete. So moving on to the next slide, we'll talk about COM 4, and we expect this to be approved in Q1 26. It's got a combination of previously produced fields, as seen here, and exploration. And although not fully awarded, we have been preparing already. We've just completed a high-res EFTG survey, which will integrate with existing 2D seismic data. We're planning re-entry of existing wells. We believe using modern technologies from onshore US, we can rapidly bring Quenguela Norte back into production and exploit other discoveries in the block. And this can be then rapidly transformed to cash by trucking to the Luanda refinery. Work in the partnership has already commenced. On award, expect us in the joint venture to move quickly on this. So on to the exploration of these blocks. We've got a couple more slides before we wrap up. So I've talked previously about why we consider the Kwanza untapped and overlooked based on analogies elsewhere when we did the webinar last year. Our position extends across 3 blocks. We continue to evaluate others. The FTG has been completed. On COM 15, the operator is moving forward on the ESIA, and we have a tender out there for 2D seismic acquisition in second half. So onshore exploration is about upside we can access at low cost, scalable, and can be monetized quickly. And just a few snippets of what we've seen already. On the left is the lead map for COM15. You can see that there's a number of leads mapped, and this will mature as now we've completed the FTG. We've got a number of leads mapped across the whole of the acreage. On the bottom of the slide is a cross section through COM15, and it shows Bamboo 1. That demonstrates a working hydrocarbon system. We have other wells on the block, but it shows a typical Gulf of America style salt type here with structures around them. Bamboo 1 tested a turtle structure and also salt flank traps, so potential uptip. It was drilled in 1960 and encountered oil shows from 2,500 to 3,000 metres. Importantly, it also flowed oil to surface from both the Twenza and the Binga formations. We now know from recent seismic, recorded in 2010, that the well actually was drilled off structure. We have 7 square kilometres of closure and about 100 metres of relief up dip. So it is a very attractive re-entry candidate. So the last slide just brings it all together, milestones and catalysts. Offshore, 26-27 is about advancing and starting to execute infill drilling and workovers, progressing 324 towards FID, continuing infrastructure optimization. While onshore, what I hope you have heard, it's about completing the interpretation work, progressing seismic and moving selected opportunities toward drilling readiness, building the next layer of growth opportunity. So with that, I'll hand back to Paul.
Thanks, Ian. That's Anastasia. Hopefully you'll all agree that, over the last 5 years, we've successfully built a substantial oil and gas business from what was a cash shell that we entered into in 2021. It's obviously been done through a combination of the acquisitions we did early on. I think what's been very successful is not only those acquisitions and the accretiveness of the acquisitions, but the success we've had through working locally with both ANPG and Sonangol and a number of local partners, oil and gas partners, to build out the portfolio both onshore and offshore. Whilst the market can get very focused on acquisitions, I think as Ian mentioned, Block 324 is a really accretive deal. The fees paid were around about $100,000, so normal to sign up a new license. But as Ian's slides indicated, we think that investment can lead us to a very low-cost development of up to 10,000 barrels a day. So I think what you've seen is a combination of smart M&A at the beginning, followed by a smart build-out of the portfolio, utilising our kind of semi-unique position within Angola and the relationships that we have within Angola with both the government and local partners. I think Ian emphasised the very significant growth potential we already have within the asset base. I think you can see specifically how we see the future going from what is around 6,500 barrels a day at our current equity, not post the Air2 acquisition, increasing up to around about 20,000 barrels a day as we head towards 2030, so over the next 5 years. And that does not include the significant potential that Ian highlighted on the onshore acreage. So I think, we have a lot to do within the existing portfolio, but we continue to see further opportunities within Angola to add further to the portfolio through expanding our current license portfolio, both onshore and offshore. We continue to look at opportunities to acquire additional production assets within Angola. And also we continue to screen opportunities out with Angola in other parts of West Africa. However, we have to say that the setup we have in Angola, both the political stability and the very positive investment environment, tends to focus us continually back to Angola as the optimum investment location within West Africa at the moment. So we're looking forward to the coming year, a lot to do, a lot of growth to deliver within the portfolio. And with that, I'll pause and hand over for some questions.
Okay, so we've had a couple of questions come through. I'll start with an M&A one. One of AFENTRA's key strategies in recent years has been to chase inorganic growth. In January 25, the board said that it saw more opportunities for acquisitions. Reference to acquisitions seem to have died down in the past 6 months. Is there too much competition, or are opportunities now proving too expensive? Paul, let me give that to you.
Thanks. Yeah, as I was just saying, I think we spend quite a bit of time continuing to screen opportunities. The opportunity, kind of inorganic opportunity market within West Africa has been relatively quiet in 2025. There were some deals, but not so many. But it is an area that we continue to be very active in. It tends not to be the area we talk about, because you tend to talk about acquisitions when you've done them, as opposed to when you're in the process of looking at them. But be reassured, we see that as a continued avenue of opportunity. But I do go back to what I said earlier and look at the very significant value added through license opportunities, which we would argue are just as important and potentially more important than spending money on M&A. So I say, where else could you add something that can give you growth potential of up to 10,000 barrels a day for a nominal initial acquisition, effectively, of $100,000. So we continue to look at M&A. 26 looks like it may be a more active year than 25, but you'll also see us continue to very much focus on the organic growth potential in the portfolio.
An operational question just on Con 15 and Con 19 and the activity plan for 2026, which Ian covered in the presentation, but just if anything else to add.
Yeah, no, I could just answer that. So on Con 15, we've got a high resolution EFTG survey that has now been completed literally in the last few days. And the other thing there is we're the operator, Sonangol, is going to be tendering in the first half for 2D seismic acquisition, for acquisition in the second half of 26. Con 19 is just integration of the FTG over it.
Okay, another one. If the market for acquiring assets in Angola is more competitive, then why not farm out high equity exposures, given the gap between AFENTRA's valuation and the transaction value of the licenses? One question there.
Yeah, I think we saw one deal in Angola last year, and when we highlight the read-through metrics, it certainly indicates that the assets that we hold are highly undervalued when one looks at our current share price. However, what I would say is that when I look at Block 305 and the 305 area, there's very significant growth potential. So I think what you'll see us is focusing on delivering some of that growth potential as very much a first step. And as Ian highlighted, I think when he was talking about the onshore, we have positions in 2 licenses. We're about to get a position in a 3rd license. We continue to look at other licenses within the onshore, and that may or may not involve kind of trading certain equity percentages across blocks. I think what we're trying to do off the back of the EFTG, which we have the whole basin EFTG, is make sure that we've got a balanced equity portfolio across the basin, focused in on the right places in the onshore. So you may see us evolve our equity positions in the onshore. But I think at the moment we feel like the 305 area is a kind of highly prized area that we're better organically investing in.
From the most recent lifting, 21st January, $17 million of the $34 million was received in December 2025. Was this $17 million advancement factored into the year-end net debt position of $21.8 million?
Thank you, Barry. So 17 million was a prepaid instrument. It's not it's a contract liability, and it's reflected as a payable on the balance sheet. So effectively 17 million was an advance, and it was part of our cash balance. However, the liability is not factored in the net debt position.
Another question, with increasing sort of instability around Central and West Africa, what is the management's view of Angola in that respect?
Yeah, I think, as I always say, one has to look at Africa as a continent of diverse countries, diverse politics, and diverse security situations. So we do, and I'm sure some of our investors here of instance, particularly up in the Sahel area, that would be quite concerning. Northern Nigeria, recently there's been reports of insecurity. It's very much in contrast to what we find in Angola. I was in Angola just 1 week ago. Very, very calm. Angola is an incredibly politically stable area, and certainly from a security point of view, there's just no concerns at all. Certainly no operational concerns, whether it be offshore or onshore. And even from a personal point of view, you know, I find myself wandering around in Luanda feeling as secure, if not more secure sometimes, than wandering around in London. So, you know, I think Angola is a very good place to invest, both from a stability point of view, a security point of view, and then, as I mentioned earlier, you know, a very attractive fiscal environment to invest in.
Thank you. That's all the questions, and I'll hand back over to Paul for closing remarks.
Thanks, Barry. Yeah, so everyone, thank you very much for taking the time out to listen to the update today. We will continue to keep you fully aware of what's happening as we go through the year. We've got an interesting year ahead. Looking forward to significant activity both onshore as we look at the prospectivity and maybe move towards seismic, but more importantly, as we get to this inflection point where the activities that Ian mentioned offshore will start to significantly increase our production levels. So thank you very much. Good afternoon.
Excellent. Thank you very much indeed for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback, which will help the company better understand your views and expectations. On behalf of the management team, we would like to thank you for attending today's presentation, and good afternoon to you all.